This is Charles Dobbins, the multifamily attorney and the founder of the Multifamily Investing Academy. And I am here with my client, my friend, the CPA emeritus of the Owner Forum, the go-to guy in our group when it has anything to do with the taxes and the accounting of the taxes, Mr. James Liechty. Welcome, Jim. How are you?
I'm doing great. How are you, Charlie?
Good, good. So the topic today is one that every multifamily investor needs to understand. And the nice thing about this is that, you know, I teach a portion of my class on the accounting for multifamily, but my background or my understanding is more on the managerial accounting side, not on the tax side. Tax accounting is lost on me. So I am going to interview you on the topic of cost segregation, and you're going to be forced to break it down to layman's terms so even I can understand it. So,
sure.
All right. Good.
I'll be happy to, and Charlie, I'm honored to be on your podcast. I think this is great. Very exciting to have a podcast going. So
yeah, I know it took me long enough. It took me like 50. It took me about 50 years to get a podcast going. I finally decided to do it because, you know, I didn't think the internet was going to catch on, and finally I'm catching up to the podcast idea concept. So here we are. All right. Good. All right, so what we're going to do here is we're going to talk cost segregation. For some people, their eyes glaze over, but we're going to make it very simple so that they understand why they need this, why they need to understand this, how this can impact their ownership of multifamily. So let's start with the most basic question, which is, what is cost segregation?
So cost segregation, in a nutshell, it's simply the acceleration of depreciation deductions.
Okay.
And providing the documentation and support for that if the IRS were to come in and look at what you're doing.
Okay. So, now explain to us, and this is, I told you we're going to go right back to the layman's terms, accelerated depreciation. Now, I understand it, but I want, some people like, oh, geez, this is now getting gray for me. Explain accelerated depreciation and why it's beneficial.
So here's what happens. When you buy an apartment complex, you're really buying in the IRS's view, you're buying land, you're buying a building, and then you're buying personal property, which is stuff like the carpet and cabinets and things like that. And very often what happens is, you know, a lot of CPAs or tax return preparers, what they'll do is they'll make an allocation between land, which you can't take a depreciation deduction for that. You've got to wait to recover the cost of whatever you paid for land when you sell the property. And then everything else is depreciable. So 27.5-year property, let's say you buy a building cost, you got $1 million or $2.7 million, let's say, that's allocated to the building. You're going to recover that $2.7 million over 27 years. So you get basically $100,000 a year in a deduction. If you do a cost segregation study, you can take the amount that's allocated to the building, and you can recover some of that over a 5-year recovery period, some over a 7, some over a 15-year recovery period. And so the net effect of that is that you front load your depreciation deductions. So your depreciation deductions in years 1 through 5, I don't have the exact numbers on this, but you know, they could go from $100,000 up to $300,000 or more, and you have that deduction for 5 years. And then after your 5-year property falls off, then your deduction falls down to $80,000 a year or something like that.
Okay.
So your total deduction is not going to change. It's just going to front load.
And so, No, so all of these deductions, this is where it comes down to doing the tax return for the property. It means we're not paying taxes. We're paying a lesser tax to the IRS than we would have without the cost segregation.
That's exactly right.
Yeah. Okay.
And one of the big benefits. Now, there's a couple of things, rules of thumb I use for cost segregation. Sometimes it makes sense to do a cost segregation study, and sometimes it doesn't. So where it does make sense is where you own property, you're paying tax, and you can use additional deductions. So a common thing that can come up in multifamily and investing in real estate for tax purposes is if you're considered to be a passive investor, so you're not a real estate professional,
right,
your depreciation deductions can be limited. So, you know, in that situation, maybe it doesn't make as much sense. Another situation, another factor that I think you want to consider if you're going to do a cost segregation study is how long are you going to own the property? If you're planning on flipping the property in a year or two, it probably doesn't make a whole lot of sense to do a cost segregation study.
Okay.
The rule of thumb I use is about, if you're going to hold property for about 5 years or more, that's when it starts to make sense.
Because then especially because some of those expenses are within that 5-year schedule. I think what you have
Yeah, well, it's really a time value of money play when you come down to it, and net present value play.
okay.
Because really, what you're doing with cost segregation is you're taking depreciation deductions from year 27, and you're moving it to year 1.
Okay. Now,
right. So when you that's the way the more sophisticated investors will look at it.
Now, what we're doing here is, like, for instance, I remember listening to one particular accountant talk about this. Like, for instance, the asphalt and the the curbs, those get segregated out, and they're accounted for differently in the equation. Is that?
That's right.
Yeah.
Yeah. So the parking lot would be a 15-year property, or a 15-year asset. So parking lot, sidewalks, landscaping, trees, shrubs, stuff like that. So, and it's really, and one thing that's just absolutely huge here, Charlie, is the new 100% expensing. So anything that you identify as a 5-7 or anything with a recovery period of 20 years or less. So your carpet, your cabinets, your office furniture, your parking lot, your sidewalk, shrubs, all of those things. Now, there's a bunch of requirements to be met, but generally, if you're buying a property that's new to you after September 27, 2017, all that stuff's going to qualify for 100% bonus. And so you can deduct that all in the first year. And so if you have I was running a few numbers, it depends on, all these numbers depend on the property and they vary quite a bit. But if you have a $5 million property, typically about 15% of what you pay for that property will qualify as 5, 7, or 15-year property. So 15% of 5 million is a $750,000 deduction. And if you're at a 40% tax rate, what is that? That's, I think, about a $300,000 reduction in taxes that you pay.
Yeah, nice.
So and that's all in year 1. So it's a huge. If you can use the deductions, it makes a lot of sense.